Hello, listeners. I am Deepak Jotwani, Assistant Vice President and Sector Head at ICRA Limited. And through this podcast, I will be sharing our views on the recent trends and outlook on the Indian pharmaceutical sector. ICRA expects the revenues of its sample set of 25 Indian pharmaceutical companies, which account for close to 60% of the overall Indian pharmaceutical industry, to grow by 9 to 11% in fiscal 2024, post a YOY growth of 10% in the previous fiscal. The same will be primarily supported by 11 to 13% expansion in the US market and 7 to 9% growth in the domestic market, while revenues from the European market and emerging markets are expected to rise by 11 to 13% and 13 to 15% respectively. The operating margin for the sample set is expected to improve to 22 to 23% in fiscal 24 against 20.7% in the previous fiscal. This will be supported by new product launches backed by increased focus on complex generics, specialty molecules, easing of pricing pressure, and some benefits of volume expansion and better pricing due to product shortages seen in the US market in recent times. The overall credit profile of Indian pharmaceutical companies is expected to remain healthy, supported by their stable earnings profile, comfortable leverage and coverage metrics, and strong liquidity position. ICRA expects the R&D expenses for its sample set of companies to stabilize at 6.5 to 7% of their revenues, as these companies will be optimizing their spending, focusing more on complex molecules and specialty products against plain vanilla generics. Taking a bit of a deep dive into the US market in particular, this market has been a key market for most Indian pharmaceutical companies, accounting for a sizable share of their revenues. However, the share of revenues from the US market for ICRA's sample set of companies declined to close to 35% in fiscal 22, vis-a-vis almost 40% in fiscal 2020, owing to consistent pricing pressure, lack of major blockbuster products going off patent, and increased regulatory scrutiny in recent years. Nonetheless, with easing of pricing pressure, significant new launches, and shortage of some products, the same increased to around 37% in fiscal 23 and 38% in H1 fiscal 24. Apart from some key drugs going off patent, product shortages in select therapeutic segments such as oncology, pain, anesthesia, cardiovascular, amongst others, in the recent quarters have also been a key growth driver for generic companies in the US market to some extent. These shortages in the US market have been partly caused by lower production/discontinuation of operations by some pharmaceutical companies, including some local ones, owing to persistent pricing pressure, supply chain challenges, and increased regulatory scrutiny by the US FDA. Parallelly, the incidences of warning letters and import alerts issued to manufacturing facilities of the Indian pharmaceutical companies have also increased over the past year and thus remain a key credit risk. These have led to delays in product launches for some companies, translating into failure to supply penalties and entailing significant cost burden towards remedial measures, including hiring consultants and consuming additional management bandwidth, in turn impacting their profit margins. ICRA expects the revenue growth of its sample set of companies in the domestic market to be around 7 to 9%, supported by increases and new product launches. In H1 fiscal 24, ICRA's sample set of companies witnessed a growth of 7.2% on a YOY basis, negatively impacted by the price reductions required to be undertaken because of the price caps under NLEM on various products, besides an uneven monsoon which affected acute sales therapies. Apart from this, leading Indian pharmaceutical companies have also made sizable strategic acquisitions in the recent past to enhance market share in select geographies and therapeutic areas. Most of these acquisitions have been towards strengthening therapeutic coverage, primarily in the US and Indian markets. This is expected to provide diversification benefits and support revenue growth for these companies going forward. The sizable quantum of most deals also indicated the elevated risk appetite of these pharma majors. However, given the sizable debt-funded acquisitions by some companies in fiscal 23, a key metric, total debt by EBITDA of the sample set of companies, increased to around 1.25x as of 31st March 23, as against 0.9x at the same time in the previous year. Nonetheless, this metric is expected to remain comfortable at 1 to 1.1x over the near to medium term, despite high capital expenditure, primarily supported by healthy internal accrual generation. Thank you for listening and stay tuned for our upcoming podcast.
sector.